It's the start of a new year, and Harvest is back at it again to launch a new lineup of ETFs. Last year, it was HPYE and the lineup of high income shares single stock ETFs. But this time, the focus is on what they call the Premium Yield ETFs. These Premium Yield ETFs were announced in early December 2025, and it sparked a lot of curiosity, because how would Harvest be able to offer more premium yield without cannibalizing the already very successful HPYE ETF? Well, now we have a few more details with the release of the individual ETF pages, along with the product sheet which outlines what the strategy looks like and will entail. If you haven't subscribed to the channel yet, consider subscribing to support the channel so you can follow along for future videos. And with that, let's get into what we know so far. So in the news release, Harvest announced that they will be launching two new ETFs. The first is the Harvest Premium Yield Canadian Bank ETF with the ticker symbol HPYB. Then the second one is the Harvest Premium Yield Enhanced ETF with the ticker symbol HPYE. These will be the first two in a new lineup of ETFs called Premium Yield, where the focus will obviously be the yield, as it says in the name, and they will all share the same underlying strategy. Some of the other things that were mentioned was that they will pay distributions twice a month, and will be leveraged. What stood out though was the option strategy, where they'll write cover calls and/or put options on the portfolios. This is something we haven't seen yet being offered in the Canadian cover call ETF space, so many were curious to find out more about what it entailed. Well, with the recent update to the website, we get a first look into some more of the details and get a better idea of what we can expect. For this video, I'll just cover the HPYE ETF, but just keep in mind it'll be the exact same strategy for HPYB, except instead it will just hold the big 6 Canadian banks. So the first thing that stands out in the header is that we can expect these to start trading in January 2026, which there will only be 2 weeks left in the month by the time this video is released. Scrolling down, the investment goal here for HPYE reads that the Harvest Premium Yield Enhanced ETF provides access to a diversified portfolio of leading and trending US equities. The ETF offers twice monthly cash distributions, along with capital growth potential. It utilizes leverage up to 50% and an active options writing strategy, targeting both calls and puts to enhance monthly distribution yield and overall growth. The first thing that stands out is the increased use of leverage up to 50%. This isn't something we've seen yet in a cover call ETF, as many of them initially started with 25% leverage, and we only recently began seeing products with 33% leverage. So this jump in leverage is a big eye-opener, and is bound to provide a much higher and premium yield as it states in the product name. I think we'll have to wait before passing judgment on this, as it does state they will have an adaptive equity exposure, and the wording of up to 50% means the amount can also vary. The only other details, if we scroll down a bit, are that the management fee is 0.65% and the risk rating for it is medium. For some more information, we can go back to the header of the page and then look at the product sheet that was also posted. Most of the information on the left we already gone through, but on the right side where we see key details is where it'll give us a little bit more on what we can expect to be disclosed once it is released. Unfortunately, right now all these are listed as TBA, but on release this will tell us the yield, how much equity exposure, cover call exposure, puts exposure, and total gross exposure we will have. Then scrolling down, we get a diagram of what they're calling their active equity income strategy. The first thing that came to mind when seeing this is that it resembles a popular option strategy that many options traders use, and is the options wheel strategy. What this will likely start with is an initial basket of the 20 equities. And then, depending on the market environment or current cycle, they will start to sell calls and puts on that portfolio to generate the options premiums for distributions. So if we are in a rally cycle, they'll increase the cover call exposure to collect more premiums, because in these periods the IV or implied volatility can become elevated. It might seem a bit counterintuitive, because you could be capping more of your upside, but the purpose here is to generate a higher yield. But that's where this next part comes in, and that is where they're also using puts to buy up the equities during dips when there are pullbacks. With these puts, they also collect premiums on the options. So with this, they are being paid, while also buying up the equities at a discount in order to build up the equity exposure again. Then when a recovery or rally happens, they can then repeat the cycle and increase the cover call exposure for more premiums. Keep in mind, when they are building out their equity exposure on the dips, it also means they will also capture more of the upside delta too with their larger position. In order to showcase all of this information visually, I decided to try and put together a chart to help in the explanation. There's also some additional information I found from the prospectus that went into making this, which I'll show along the way. The first piece of information was actually at the bottom of this PDF, where it mentions that the fund employs a modest leverage of approximately 25%. So my understanding here is that the initial basket of 20 stocks will be equal to what they would consider their 100% equity exposure. And then they would apply the modest leverage of 25% on top of that, with the potential that leverage going up to a maximum of 50% leverage based on the options writing. This last 25% of leverage could then be seen as being used more opportunistically. It might not be something they have on all the time. Then, the next piece of information is mentioned in the prospectus, where it says that each month, cover call options or put options can be written on up to 66.66% of the equity securities held in the portfolios. And also, they may additionally write cover put options on securities that are not currently held in the portfolios but would like to add. To show how this would stack up, if they were to use up to the maximum of 50% leverage, this is what it would look like for the coverage. For some perspective, we can overlay some lines to divide up each of these bars. So, at the maximum leverage and right level, they can have up to 100% of the portfolio covered, while still leaving approximately 50% to participate in the growth of the underlying holdings. This is of course the most absolute extreme example, and how I'm interpreting the information myself. In all likelihood, they will probably be much more conservative than what I'm showing here on the chart. So we'll just have to wait and see what the exact details are once they are released. And finally, at the bottom we also get to see what the 20 holdings in HPYE will be. From the looks of it, it'll be much more diversified than what HHIS currently holds. Some of the holdings do overlap, such as Apple, Amazon, Broadcom, Alphabet, Eli Lilly, Meta, Microsoft, and Nvidia. But as an entire basket, there's a good diversified mix of technology, financials, and also some blue chip dividend stocks in the portfolio to balance things out. I should also mention that these 20 holdings will be equally weighted, and if you aren't sure about the importance of that, you can watch my previous video for some more information and why it can be impactful. So overall, from a first look, there's definitely a lot more active management involved with the strategy for these premium yield ETFs. It'll be exciting to see how they execute on this and how it'll perform over time. But what do you think, and does this strategy interest you? Let me know in the comment section below what your thoughts are, and if you'll be adding either of these ETFs when they come out. Don't forget to subscribe if you haven't yet, and also comment if you'd like for me to do another video on the strategy once they are released. Thanks for watching, and I'll see you in the next video.